Trump stirs the tariff pot again, but this time his threats are aimed at the EU and China. Well, late on Tuesday, President Trump said that his administration was discussing imposing a 10% tariff on goods imported from China, and also vowed duties on European imports. The reaction in the bond and currency markets, however, was muted. So does this mean that traders have already priced in the impact of Trump's trade policies? Well, let's ask James's Place's head of economic research, Hetal Mehta. Hetal, has the threat of higher inflation as a result of tariffs subsided, or is this something investors still need to be wary of?
I think investors do need to be wary of the short-term impact that tariffs could have on inflation. I think maybe the muted market impact is largely because this has been well trailed. After the election, which was more than 2 months ago, we knew that this was the direction of travel for policy, and the announcements we've had so far aren't actually a big surprise in that sense. But in the near term, tariffs will be inflationary. It takes time for trade to be rerouted, for supply chains to adjust, and for demand to adjust to that, as well as the currency. But take that kind of short-term bit away, and longer-term, tariffs is more friction to trade. It's less good for growth, and actually it should be disinflationary in the medium term.
You talk there about growth. So what's your overall assessment of the US economy? Will we still see growth this year?
I think we're going to see quite good growth, a slowdown, but we're starting from a very, very robust pace. So growth has been in the region of about 3% in the last 12 months, and just moving somewhere closer to 2% or closer towards potential is still actually a good outcome, but it is a slowdown of sorts.
And so what does this mean for interest rates, and what do you think the Fed will do this year? Are we expecting a lot fewer cuts?
Well, so I think given where inflation is, we do think that the Fed is in a more comfortable zone for cutting, but then so much will depend on these policy announcements, and the unpredictability of policy is something that the Fed will have to navigate. But on balance, we don't disagree with market pricing that markedly. I think a couple of cuts this year is kind of reasonably fair to assume.
So does that mean we'll see a bigger divergence between the central banks across the world in terms of what they do with rates going forward?
It's quite possible. I mean, there are some areas which are growing at a much slower pace. So Europe has had a particularly long run of weak GDP numbers, and that improvement in inflation really does allow the ECB to cut more aggressively than the Fed. And the latest data from the UK also shows the economy is largely flatlined for some time. And so the Bank of England, although it has a bit more of a wage and inflation problem, I think is also likely to be cutting a bit more.
That was Hetal Mehta from St James's Place. Don't forget you can get more news, analysis and videos on Reuters.com.